All right, I'm going to make a quick video here to wrap up chapter 15 and make some progress even though we can't be in class today. So you may remember from class last time that we had finished class talking about stock dividends and stock splits. And we had talked about small stock dividends, large stock dividends, and we hadn't really gotten to stock splits yet. So to review, we looked at exercise 1514 with GK Chesterton Company, and we're talking about three different kinds of events that can happen: a stock dividend, a small stock dividend, a large stock dividend, or a 2-for-1 stock split. And we had talked about for a small stock dividend, the market generally responds to these like much more like cash dividends. The owners of the shares who get them seem to treat them like dividend income, and the market price of the shares doesn't really adjust that much to the fact that more value has been taken out of the company. So partly for those reasons, partly to sort of discourage companies from issuing stock dividends, which is an interesting sort of feature. Um, what happens is that companies use a market value of the shares distributed. That's the amount that's pulled out of retained earnings. Par value of the common stock that's distributed is increases the common stock distributable account, and the plug goes to additional paid-in capital. And this is something that you should have in your notes from last time. When the dividend is actually distributed, then the distributable account goes down and the common stock itself account goes up. So we debit the distributable, we credit common stock. So that's what we see in the case of a small stock dividend. In a large stock dividend, which in this case is the SEC defines that as 25% or more. GAAP says 20 to 25% or more. Um, but in this case, we have 100%. In a large stock dividend, the market really seems to treat it like these are new shares being issued, and the price tends to adjust all the way. So really what this means is there's no market value distributed to owners with a large stock dividend because the stock price usually goes down pretty much exactly with the amount of shares that are being increased. So in this case, with our example, we've got a 100% stock dividend. And again, this should be in your notes. What we do is we reduce retained earnings by the par value of those shares. So we have 300,000 shares outstanding. 100% of that is 300,000. $10 par value gives us a $3 million par that's taken out of retained earnings and is held in our distributable account until we distribute it. And then we reduce the distributable and we increase common stock. Again, those should be in your notes. We went through them kind of quickly at the end of last time. So I wanted to review those and get you a little bit back up to speed. Now, the last thing that we have is a stock split. And we didn't talk much about this last time. In a stock split, it's a little bit different from a dividend in the sense that each individual share of stock in a stock split is split into multiple shares, which means not only are the number of shares outstanding going to go up, but also the par value of the shares will go down. So instead of having one $10 par share of stock, you would now have two $5 par shares of stock. Now, what does this do? Why would companies do this? In a sense, it makes no difference whatsoever because the number of shares is doubled, but the value that each one holds, either in a par value or in a true market value, the value would be cut in half. So you own the same thing. Generally, why companies do this is because they want their stock to be in a price range that makes it easy for more people to buy and sell the shares of stock. Not every company does this, but quite a few companies. If their shares go above some number that they think makes it sort of psychologically difficult for people to buy and sell, if the shares go above $80 or $100, and they want there to be more trading activity in the stock, and they think that the shares are going to stay above 80 or 100 for a while, they might use a stock split, which would double the number of shares, cut the market price in half. And so now instead of trading at 100 or 120, now the shares are trading at 40 or 50 or 60, something like that. And that seems to be something that people in the marketplace prefer lower priced shares so they can buy and sell them as they need to without engaging in huge dollar transactions. I think it's more psychological than anything real in terms of value. That's why companies do it. You also will see companies, if their stock is really, really too low priced, they'll do a reverse stock split sometimes. So they'll do a 1-for-300 stock split, and they'll take 300 existing shares and combine them into one, which has the impact of raising the price. So instead of your stock shares being at 2 or 3 cents a share, you put them together and you get $60 per share or something like that, and that becomes more of an attractive trading price because a lot of people get scared off of a stock if the price is too low. So those are a variety of reasons you would do a stock split. You split your number of shares into greater shares. Now, from an accounting standpoint, with a stock split, this will be your favorite because there's no entry to make. The company will generally make a memo entry to record the change in par value, but there's no account to debit, there's no account to credit in a stock split. The total par value that's outstanding doesn't change. None of the paid in capital changes. There's really nothing to record from a financial accounting standpoint with the stock split. So we have here 3 different types of stock transactions with owners: small stock dividends, large stock dividends, and stock splits. Now, this all gets a little bit complicated. I'm aware of that. So what I have done for you, and I'll post this to Canvas, is I've made a table of the various kinds of dividends that we've talked about and how they are accounted for. So with a cash dividend, when you declare the cash dividend, you decrease retained earnings, and therefore you decrease total equity and you increase liabilities because you've got dividend payable on the books. When you pay the dividend, you decrease total assets, generally cash. Well, definitely cash if it's a cash dividend. And then you decrease the liabilities. So that's sort of what we're trying to do with a cash dividend. With a property dividend, we have the same decrease to retained earnings. We also have to record the increase or decrease of the gain or loss. So you'll remember the example we have in class where we had marketable securities that were carried on the books at lower than their market value. When we declared the dividend in that example, we had to write those values up. And so we had a gain, an unrealized holding gain, and that's going to increase total equity to some extent, but also the total value of what's being declared as a dividend will decrease total equity because retained earnings is decreased. So how those two things net out to each other is going to be impossible to tell. You have to look at the details. But it will also definitely increase total liabilities because we have the dividend distributable. And then when we distribute the dividend, we're going to decrease the assets, whatever the marketable securities, whatever else we're distributing, and we're going to decrease our liabilities. So it's a property dividend. Then we have stock dividends, and we've got 2 different kinds, small and large. With a small stock dividend, we are going to decrease retained earnings by the market value of the shares that are being distributed. We're going to increase capital stock by the par value, and additional paid in capital is going to increase by a plug. So it's going to be your journal entry. Now, what I'm leaving out here in this table, just to keep the table cleaner, is the difference between the declaration and the distribution. But at the end of the day, this is what the effect is going to be. And the stock dividend will increase the number of shares outstanding, but it does not affect the par value per share. With a large stock dividend, we are going to again decrease retained earnings, but we're going to do that with par value. And we're going to increase capital stock with par value. There's no entry to additional paid in capital, and the number of shares outstanding will increase, but again, there's no change to the par value per share. And then finally, our favorite, the stock split. There's nothing to record. So there's no effect on retained earnings, capital stock, paid in capital, no effect on any assets, liabilities, or equity. We do increase the number of shares outstanding, and we decrease the par value per share. And the amount of those increases, decreases are going to depend on the value of the split. If it's a 2-for-1, 3-for-1, 4-for-1, 10-for-1, however the company wants to split. And I also put here a reverse stock split because occasionally you do see those. And those would, of course, decrease the number of shares outstanding because you're combining many existing shares into fewer shares, and that would increase the par value per share. Now, notice what I've left off of here. I haven't talked about the market price, how the stock market responds to these things. To a certain extent, that's always going to be a little bit difficult to predict because the stock market will always react based on not only the particular thing being announced, but what they think it means about the future of this company, what else is going on in the economy and the market with competitors and in politics, whatever else is going on. Generally, you will see um, the market price respond exactly with a stock split. If it's a 2-for-1 stock split, you'll generally see the market price come down pretty much exactly half. Because that's exactly what ought to be doing, and the market sort of knows that a stock split is, in a sense, a meaningless event, but it does bring the stock price into a better trading range. With stock dividends, again, the larger the stock dividend, I think the more likely you are to see the market price adjust fully. With a small stock dividend, I think it's less likely to adjust fully. Okay, so we've talked about stock splits and dividends. We've talked about the accounting for these. One more thing I want to do for chapter 15. Let's talk about the financial statement presentation of shareholders' equity. And so I've got Kroger as an example here. And I'm going to talk about what kinds of things I'll expect you to be able to do for an exam, for example, on shareholders' equity. So we see the presentation of shareholders' equity, and Kroger has not too many crazy things going on here. They have what we have is the shares listed in order of preference. So preferred shares who get paid back first are listed first. Common shares get paid back second, so they're listed second. So if Kroger were to have to go bankrupt and liquidate or something like that, anyone who owned these preferred shares would get paid back before any common shareholders. Then we have additional paid-in capital. Kroger has not broken down, well, actually Kroger only has paid-in capital from common shares probably. It's possible that they are lumping in any treasury stock paid-in capital, and reductions to this number could be buried in that number. We can't tell from the balance sheet by itself. Then we have accumulated other comprehensive loss. In accounting 307, you would have talked about other comprehensive income. In this case, it's a loss. Then we have accumulated earnings, which is Kroger's word for retained earnings. Not sure offhand why they call it accumulated and not retained. Doesn't make a bit of difference. So, we have our contributed capital and then our earned capital, and the contributed capital is listed in preference order. Then the earned capital is accumulated other loss and accumulated earnings. And then we have our treasury shares, which are a reduction of equity in total. So Kroger has not listed them as a subtotal specifically, but what they have shown is that all the treasury stock is reducing the total capital available from both contributed and earned capital. So that gives us our total shareholders' equity, and that's in this case $6 billion. Then we have a small adjustment for non-controlling interest. What that is that there's a company, or there might be multiple companies, who are consolidated into Kroger statements, but Kroger doesn't own 100% of them. So the portion that Kroger doesn't own gets carved out here. And then here's total equity. So contributed capital, earned capital, order of preference, treasury shares as a reduction of total capital. Those are what I want you to understand for the balance sheet presentation. And for the statement of changes in shareholders' equity, what we have is there's a lot more detail on here because there's a lot of there are transactions for each one of those accounts. And we also see share amounts and number of, or dollar value for both common stock and treasury stock. So we see a lot of detail here. Generally, how these are going to be laid out is you've got the balances at the beginning of the year, you've got all the transactions that happen throughout the year, and then balances at the end of the year. And you've got that for all of your various accounts. So everything that we saw on the balance sheet, common stock, paid-in capital, treasury stock, accumulated other loss, and accumulated earnings, and the non-controlling interest, all of those are presented here, and we see transactions throughout the year. Some of these are a little bit more than what we've covered in class. We haven't yet talked about stock options. We're going to talk about that in chapter 16. We also haven't talked about restricted stock issued, but we'll talk a little bit about that in 16 also. But we do see treasury stock activities. So we see treasury stock purchases, and those are The number of shares and the cost of those are showing up. We see dividends reducing retained earnings. We see net income increasing retained earnings or accumulated earnings. Don't know what's in the other account without looking at the notes, but this is kind of straightforward stuff. Again, we see just a list of all the transactions that affected each of the various accounts. Again, this is something that I expect you to be able to either read or interpret or create for an exam.